Vivek, when I look at the US equity markets, the S&P 500 is down only about 7% below its record highs. And I say only in in relativity in relation to what other world markets have done and markets like India as well. And this is coming in despite this kind of shock and new world that one is adjusting to. Equity markets, you think, are in denial, or do they know something that the bond markets don't know perhaps right now?
Well, who's right and who's wrong is really difficult to say, but what we can observe, as you say, is that there's a difference, right? And I think when we're looking at how markets have reacted, we need to kind of think about what are the underlying drivers of what's causing their reaction, okay? So one aspect could be the fact that rates have repriced, and all else equal, rates being higher than otherwise anticipated would imply that you're going to get lower returns because effectively the discounting value of future cash flows kind of changing, right? I think what we're seeing thus far is that equity markets are reacting to the rates and implicitly the inflation dynamic, but not necessarily that materially to the growth. So if you were to add on a worsening growth picture, if you had to add on the idea of, for instance, consumers not being able to react as well, if you add on the idea that earnings are going to be less good than previously anticipated, then there's further to fall from here. So I think the dynamic I would say is, look, there's a difference across the two markets. I think that if you were to get a more material impact on growth, you'd see that still turning up in the equity figures from here, but it's not inevitable that that's what's going to happen. We need to remember that there are upside outcomes here too relative to current market pricing. And if we were to get a favorable de-escalation, markets could snap back quite quickly, quite fast.